Hey everyone, welcome back to Streetwise Economics, where we break down complex global finance into simple, street smart insights. Disclaimer though, this video is for educational purposes only, it's not meant for investment advice. Always do your own research before making financial decisions. Today, I'm diving into one of the biggest global stories right now, the escalating trade war between China and the United States, and what it means for the stock market, bond market, and currency market. So let's break it down. According to trading economics, China's trade surplus jumped to over 102 billion in March, driven by a huge spike in exports. And it's no coincidence now why some companies such as Apple and other companies that have manufacturing plants in China before the eve of the tariffs shipped most of their products that they could out of the of China. So after President Trump levied the tariffs, particularly on China that were quite high, China retaliated, raising their tariffs, and this process actually happened in such a way that as I'm recording this, the US fired back with 145% tariffs on select Chinese products. And China also indicated that they were prepared to fight to the bitter end and increase their tariffs rate on US goods, on some American goods by 125%. What does this mean? More than just headlines, this shakes the global markets in my view. We have seen the sell-off in the US market, a drop in the bond markets, which is unusual, as I will explain, and even the US dollar fell against the euro, even though it has rebounded by a bit. But why? What does it mean for you and me? Let's go step by step. First, what is a tariff? In simple terms, a tariff is a tax on imported goods or services. If the US puts 145%, as in this case, this 145% tariff on Chinese product, it becomes much more expensive for Americans to buy that product, which discourages import. Same goes the other way. If China slaps a 125% tariff on American goods, fewer Chinese businesses will want to import US products that are on this tariff list. So tariffs essentially are meant to protect domestic industries, but they are also a tool that can probably cause some trade tensions and lead to retaliations, as we are seeing now. So let me dive back and go a little bit deeper in terms of the market reactions, starting with the stock market. Investors don't like uncertainty, and trade wars create a lot of uncertainty, especially the way the tariff playbook is playing out in the US. You have this week, the tariffs have been paused, then they are rolled over again. So big US importers like tech and manufacturing companies are seeing the stocks drop. You look at companies such as Amazon, Apple, their stocks dropped by over 30%. There has been also overall a broad sell-off in the US stock market as investors fear lower global demand and higher costs. If you look at the S&P 500, it dropped at some point to almost bear territory, even though it did not close the day in that 20, at least 20% region. Because what happens, the bear market is if the market falls by at least 20% from the highest point in that particular time frame. So in this case, this is what has been happening. If I look at the bond markets, normally when stocks fall, investors rush to bonds as a safe haven, particularly the US bond markets. So Right now, we are seeing that bond prices are also falling, causing the yield to increase. And what this means is that the interest rates are increasing, which is contrary, in my view, to what I saw Secretary Bessent and even President Trump's intentions, saying that they wanted to lower these interest rates. But what then happened is that it achieved the opposite effect. And long-term bonds like the 10-year US Treasury, they actually were very volatile, which is very unusual. And this is a market that is very, very predictable, at least from my experience. That is the bond and the current market, at least. So once there is instability there and there's instability in the stock market, then it becomes very difficult for investors to find which way to actually hedge their portfolios or to make money, at least in my view. So why is this happening? Because global investors are actually pulling out of the US market altogether. If you look at the bond market, there has been information that investors, they are nervous about where the global financial markets are headed. And the US used to be a good safe haven, even the US dollar as well. Now, moving on to the currency market, the US dollar has been falling against the euro for some time, even though it recovered a little bit. And that's unusual during times of fear because the dollar is normally a safe haven. If you look at DXY, which is an ETF that actually tracks the basket, the US currency versus to the other basket of currencies. So usually people, even myself, I would like to hold some US dollars such that maybe if the market drops on the short term, I would then, buy stocks or even exchange my money, which is US dollar, which tended to appreciate over time. And then let's say I want to buy stocks in Chinese renminbi or maybe in euros or maybe in Canadian dollar, I would then exchange. So it was a good store of value over the past couple of years, for the past couple of years. But this time, investors are seeing that the US is now at the epicenter of uncertainty because of the tariff hikes. Meanwhile, China might look to shift exports to Europe, Latin America, and other parts of Asia. I was watching on YouTube that President Xi was actually in Vietnam a few days ago, and I read a report that China is also talking to the EU to come up with potential collaborations and agreements, bilateral in this case. So this might be a shift in the way the global finance might be going forward. That's something that even notable economists like Paul Krugman have been writing a lot about. Now, let me dwell a little bit more about the 10-year Treasury bond. It's super important because it's one of the most watched indicators in finance. You see, it represents long-term confidence in the US economy. It is also a benchmark for mortgage rates, business loans, and more. Here is why this is key. The Federal Reserve Bank controls short-term interest rates, like the overnight lending rates. Even here in the Bank of Canada, that's what they do. They control the overnight lending rate. But the markets set the 10-year yield. So when investors sell the 10-year bond, the yield goes up. So that's what happened. It went up to even, I think, 4.8%. When they buy it as a safe haven, the yield goes down. So if the 10-year yield is moving up, it often means the investors are worried about inflation or long-term instability and not finding safety in US assets right now as it were, or as it has been the case. Now, why does this matter? These markets don't move in isolation. They are connected, in my view, at least in theory and in practice, actually. When tariffs rise, it increases the cost of doing business, hitting stock prices. So companies' profit margins might fall. So as an investor, when I buy shares for Walmart or Amazon, I am betting that if I'm going long, the stock is going to appreciate, maybe the profits are going to increase as much as the price or the value of that share. So uncertainty can lead to selling in bonds and currencies. A weak dollar can hurt imports but help exporters, although tariffs complicate that. If China shifts trade elsewhere, the US could lose influence in the global markets. So investors look for stability. And right now, many don't see the US as a safe bet. Things have really changed, in my view, fundamentally and structurally. So money has been leaving the US, selling US bonds, and even moving away from the dollar, a rare triple move. So if you look at Japan, China, which held a lot of US treasury bills, them selling, in other words, it's like, you know what, no thanks. It's a vote of no confidence, basically. So let's look at the bigger picture and let's talk scenarios here of things that might potentially happen. It's extremely difficult to predict exactly what's going to happen in the future. For sure, I must share that. But this is the way that I'm just thinking of these two possible scenarios. Scenario one, China and the US decouple completely. And this is an extreme case. Let's say they stop trading with each other and build new trade alliances. The US might deepen bilateral deals with allies like India, Vietnam, Latin America, or even Africa. Whilst China could expand trade into Africa as well, Europe, Southeast Asia, like I've indicated that President Xi was in Vietnam, this could reshape the global supply chains, affecting everything from iPhones to EV batteries. But here is the risk. The US loses a major trading partner, which is China, and American companies could face higher costs and lower growth. If Apple, Tesla, their factories in China, and I think China's exports to the US, they amount, I think, about 2% of their total exports, and that's just to the US. So that's the market. It's going to take a hit, of course, right? China, by this scenario playing out. Now, if scenario two was to happen, negotiations to begin and to conclude in cooler heads prevailing, and if we were to retain to normalcy, the tariffs could ease, markets could recover, and global trade could stabilize. For now, the markets are betting on more volatility. So here are the key takeaways as I wrap up. Tariffs are a tax on trade and they ripple through the global economy. Stock, bond, and currency market are currently really feeling the pain. The 10-year treasury is a critical signal on long-term confidence. The US dollar isn't bulletproof, and investors are watching it closely. So the trade war is far from over, and the impacts are beginning to unravel. So as I wrap up, if you found this breakdown helpful, give this video a subscribe or even share this video and drop a comment below. Do you think that the US and China will reach a deal, or are we headed to a permanent global trade realignment? Let me know what you think, and thanks for watching. Stay informed, stay sharp, and as always, stay streetwise, trade and invest wisely, and may the markets be on your side. Bye-bye for now.